This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Christian Czernich, CEO, founder, managing partner at Round2 Capital. Round2 is a financing partner for European scale-ups with digital and sustainable business models. In the scale-up phase, outstanding entrepreneurs manage to transform their business from a successful venture into a real company. Round2 offers the innovative funding instruments and insights needed to master this transformation process. Founded in 2017, Round2 has pioneered revenue-based finance in Europe, flexible, non-dilutive funding instrument. Christian, thank you for joining us.
It's a pleasure to be here.
Great. So what was your background before investing in early stage companies? What did you do before this?
Well, I spent the last 16 years doing deals, first as in investment banking and then in private equity. And then eventually I started my own business that was right after the financial crisis. And we did a lot of mid-market transactions, M&A. And then I started to do direct investments, and that eventually then evolved into Round2 Capital, where we do revenue-based funding, predominantly of B2B SaaS firms in Europe. Before my career in investment banking, I had an academic career, so I did my PhD at the Stockholm School of Economics, where I did in-depth research of technology spin-offs. And also in venture capital, I also spent a part of my studies at Stanford University in the PhD program, which was a great time back then, right after the first internet crash. That was 2001, and I had the pleasure to talk to a number of very well-known VCs at that time, and I got really inspired of that industry.
Great. So what excites you right now?
Well, I mean, of course, so we are investing predominantly in SaaS. So obviously, I mean, I'm very excited about digitization and what various SaaS companies can do for supporting the digitization of society. In Europe, we still lag a little behind other countries, or especially the US, when it comes to the degree of digitization. I really like the SaaS business model for a number of reasons. Of course, one of the major reasons are the recurring revenues. So if a SaaS model is run in a good way, the development of the company is quite stable and predictable. The companies don't need any working capital, and the capital intensity to set up such a business is not so high. So if you have a good concept and you know how to program well, you can get started with a business quite easily. So I like that because that opens the market, and it's easy for good entrepreneurs to start a business.
Great. And so you see a lot of startups and a lot of investors. What's your advice for people investing in startups? What do you tell them to do before they write that check?
Well, I think what still a lot of people underestimate is the huge difference between B2B and B2C business models. Now, if it's a totally different world, whether you invest in a B2B model or in a B2C model, my advice is for investors to really think that through until the end, what it means to scale a B2C business as compared to B2B model. I often see entrepreneurs, but also investors who totally underestimate the time it takes to scale a business and also the capital it takes to scale a business. And both of these dimensions are totally different for B2B and B2C. So for me, I would say that B2C can be scaled much quicker, but with much larger capital needs. And the B2B model is much slower to scale, but you can also do it with lower capital needs because you don't have to have this huge marketing budget.
Great. And so what's your advice for people running startups? What do you tell them to do before they go out to raise funding?
Yeah, so, well, I would say, the most important thing is, test before you scale. So I really have I meet so many entrepreneurs now every week, and it's so many people out there who just start raising capital because they think it's cool to raise $3 million, $5 million, $1 million, whatever, but they don't really understand their own economics and their own business model. So I think it's extremely important that you first know your economics and you test your model, and then you go out and raise the capital. I understand that's tough. It's I experienced that entrepreneurs focus more of their time in raising capital than in testing their model and acquiring customers. But at the end of the day, if you want to build a great business, there is no other way. You need to perform, and then you will get the capital, and it's not the other way around. Right. So, and I think that's really my major advice. Then take it step by step. That's also, of course, we all see these huge successes out there of now recently Zoom, or all these examples, and everybody thinks, okay, I'm going to do that again, and I'm going to do that as well. And that's simply not possible because that's just very rare and exceptional cases. So I advise entrepreneurs to take it step by step and be a little bit patient, and then they will succeed. I think also another advice, which I also see very frequently, is get a CFO. So that's really, at least the companies that I see, if they don't have a CEO of the businesses, it's just impossible to scale. See that at the beginning, the founders do the finances just a little bit on the side, and they think that's just how it's going to work also when they start growing and really scaling up. But that's of course not the case. So you really need to get a CFO, and finally, at least what I've seen is you need to run your business on your own as a founder. So I've seen a couple of firms that try to hire an external CEO pretty early on in the process, and that just doesn't work. Now, if you as a founder cannot run your own business and cannot scale it on your own, you shouldn't do it.
Well, great. Well, let's talk about the state of startup investing. How do you see the industry evolving going forward?
I think, in my view, at least when it comes to SaaS and to digital companies, the market is getting a little bit more mature. I think there's a much better understanding out there now, both on the investor side, but also on the founder side, how the business model is really working and what it takes. And that's of course good, because now there's more knowledge out there, that everybody's getting more professional in dealing with SaaS business models. But then on the other hand, also, if the market's getting more mature, the dreams are getting more realistic, I would say. So now I think that the outlook for building I'm always talking about SaaS here, but for building a SaaS business has become a little bit more realistic, I would say. So it's the better people understand the model, and the better they understand what it takes to scale it, the more realistic are the expectations. That doesn't mean that you can not be hugely successful, of course. There's huge opportunities out there, but it's just that people understand now better what it takes and how long it takes to scale such a business up.
Oh, great. And what do you think is the biggest change we'll see in, say, the next 5 years in this market?
Yeah, so for the next 5 years, I think that SaaS will continue to grow. So I don't think that we are at the end of this cycle. We are just, we are away from the birth phase of this industry, but it's going to grow for many years to come. What I don't believe in is these winner takes it all markets in B2B. So, I don't see that the network externalities are strong enough in B2B, so that there will be only, winner takes it all market. So I don't believe that there will be, I don't know, 5 or 10 or 20 dominant SaaS companies out there, or one dominant SaaS company per vertical. I really believe that that the market will continue to be divided into several niches, and there is space for mid-sized companies, companies with, I don't know, 20 million recurring revenue up to 200 million recurring revenues. And that's really, I think, a very interesting space that we will see now to develop. And I think that the digitization will, of course, continue. We are not at the end of digitization, so digitization will continue, and it will permeate all aspects of our life. So this old saying, "Software eats the world," I really believe into that. And it has not, by far, not eaten not even half of our world. So there's a lot of work to be done. And I actually think that's very positive, because software makes our life much more convenient. Good software is just great, it makes life better. And it will continue. So what we see then is that some consolidation is starting in the SaaS business in Europe, at least. Probably in the US that has started already a couple of years ago, but in Europe we really see now buy and build strategies to emerge in the SaaS space. So there is a number of investors out there who do platform investments, and then step by step acquire smaller players to build larger platforms. But again, this consolidation does not mean that this is a winner takes it all market. So I believe in number of players in each vertical. So I think in the future, and that's also our investment thesis, is that there will be many niche players out there. There will be a number of mid-sized players where you can make great returns, especially of course also with revenue-based finance, because we don't need to invest into the next Google. We are fine with companies that are growing, I don't know, with CAGRs like 15 to 70% or 50% or so, and there's a lot of opportunity out there for building these kind of companies.
Great. Well, let's talk about your investment thesis for making investments. What is the criteria you have for it, and what do you look for in startups to invest in?
Yeah, so we're a little bit different from VCs. So we do revenue-based finance. So that means we don't take a stake in the equity, but we take a stake in the revenue of the business, which has a number of advantages for the entrepreneur. Most obvious is, of course, that there is no dilution. So when we look for companies, we are different from VCs in the sense that, as I said, we don't need as aggressive hockey stick plans as the VCs would like to see. I mean, of course, we want growth, we want aggressive growth, but we don't need this, doubling your revenue every 6 months or whatever out there. I think we have more realistic expectations on the firms, and we really like what we call this sustainable business building. So we like to see entrepreneurs who are able to build their companies in a more sustainable way, which means that with low burn rates. I mean, I'm not against burn rates. There's a number of instances where it makes sense to burn capital, of course, but I see, unfortunately, so many companies, as I said before, they just think it's cool to burn money because then you need to raise more, and you don't understand your own economics, and you just continue raising capital, and there's no business model at all there. So that's not what we like. We want to see, sustainable development in the sense that, that the companies have been showing, if you give them $1 million, they know what to do with this capital, and that actually transfers into value. So that means they need to understand their KPIs and their economics very well.
Can you mention 1 or 2 startups that fit that thesis?
Sure. I mean, we have invested in a number of these companies. They are on our website. So we like businesses that are bootstrapped. There are entrepreneurs out there who can grow their business to, I don't know, 3, 5, 7, 10 million dollars yearly turnover and didn't bring in any external capital. So they just, funded their growth by internally generated cash flow, by funding for their customers and so on. And that's the companies that we like. We have a number of those in our portfolio. So we see them in different areas.
Cool. And so let's talk about challenges in the market today. What are the challenges you see your startups facing when they run their business?
Yeah, of course. I mean, the key challenge in SaaS is always sales. So we hardly see the challenge now in the programming per se. Of course, I mean, if there are sometimes the entrepreneurs make mistakes at the beginning and they don't set up a scalable software platform. But if they haven't made these mistakes at the beginning, the scaling up the software per se is not the key challenge, at least not what we experience in the companies that we look into. The key challenge is really how to organize sales and to set up efficient sales process and to understand what's working, what's not working. Is it better to use a direct channel or an indirect channel? Are you working with partners, or do you do that directly to the customers? I think that's really difficult to figure out for the firms, because there's no one recipe that always works. You just need to find it out for your industry, for your product, and that takes time and trial and error. And I think that's the key challenge. Once a business has found the model that works in sales, then they have really good chances of scaling it up. Then related to that, also what I said before is really that the startups need to understand their own KPIs. I think that just take something as simple as customer acquisition costs. Now there's, of course, the firms will always report to you some customer acquisition costs, but if you then look into detail how they calculate it, it's not always that they are honest to themselves. And so they sometimes they don't include major parts of their costs. Now they don't really understand the customer lifetime. They are not honest when it comes to churn and all of these things. So I think understanding the KPIs in detail and showing that also to the investors is a key challenge for the firms. And only once you understand your business model and your key KPIs in depth, then it's a good time to scale. So I think that sometimes entrepreneurs want to scale too early. And then they end up in a situation where they burn a lot of capital because they haven't understood how the growth engine is working.
Great. Well, you see a lot of different sectors and applications out there today. If you had to pick one or two that you'd put at the top of the list as being the best ones to pursue, what would you call out for the top applications today for investors to look for?
So, I mean, that's also, we are investing in that area is, of course, data security. We see that as a key challenge, obviously in the US, but also in Europe. It's a war out there. So European companies, and I think US companies as well, are under constant attack, from hackers, from all kinds of areas with all kinds of agendas behind it. So I would say that protecting the data that we have and making sure that it's not hacked but secure is, for me, one of the key challenges of all in Europe. I'm talking now about Europe, obviously, and I see that a number of both in the public, so politicians, but also in the corporate area, players are not fully aware of that challenge, and they don't know how to handle it. So I really see that there's a key area that we are interested in.
Great. Well, in the last few minutes that we have here, what else should we cover that we haven't?
No, I think it's, as said, we do revenue-based finance. And I come out of the equity world, so I was doing only equity deals actually in my prior career. But no, I thought that we need to find alternative ways for entrepreneurs to get funding. Venture capital and equity funding is, of course, extremely important, and it's crucial for many companies. But it doesn't fit to all situations. So I see that it has been overused because entrepreneurs, they know that they cannot get any funding from the banks. So that they just think, okay, now I need to raise equity, and then they start selling substantial parts of their business very early on. And then they cannot scale it up because they have given away their key capital, which are their equity in their business too early on. So I think it's really important that there is a market for alternative funding for scale-ups developing. And I see, again, here in Europe, the market is very, very early. I mean, we are really the pioneers in Europe. We started this, and we have an enormous inflows of companies from all over Europe coming to us. So last year, we have seen around 1,000 companies coming to Round2 to ask for funding. And that just shows that there's an enormous market need, which is good for us. But I think it's, from a societal perspective, it's important that this alternative funding market is developing so that we make sure that young companies that are scaling get the funding they need and they get in the right way.
That's great. Well, how best for listeners to get back in touch with you?
So yeah, you can reach me via our website or via email or via LinkedIn. So I'm always very curious and happy to get new contacts, and I'm always open for discussions and conversations.
Great. Well, we'll put those in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Thank you, Martin.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.